Let's go to FIIG Securities. We've got Jonathan Sheridan joining us this morning. Jonathan, all eyes leading now towards the RBA, of course. How are you seeing maybe positioning in the bond markets or even currencies ahead of that?
Yeah, good morning, Brooke. I think that everyone's on the sidelines, to be honest. I think people have squared away their positions for the quarter end, and they're not expecting much from the RBA later on today. And the key thing that maybe will move markets this week is the non-farm payrolls from the US on Thursday night. So we've seen yields flat basically overnight, and I think everyone's just waiting for that number on Thursday.
You certainly also have to work your way through, Jonathan, don't you, the ISM, which feeds into certainly some growth expectations, bigger picture for the US economy. How important is that release even tonight?
Yeah, that's right. I think, you know, that is a forward-looking indicator, and US GDP's been under the spotlight, obviously, after the terrible Christmas quarter that they had. I think that, you know, the US economy is still recovering slowly, probably a bit more slowly than everyone would like. The Fed obviously still doing their tapering of their QE program, and that's really what those kind of indicators will be looking towards, is when the Fed will actually raise their federal funds rate. And some commentary overnight from one of the non-voting members of the FOMC that'll probably be later in 2015 now. So I think that's not unexpected. People are looking to the second half of 2015 probably for when the Fed will raise that funds rate. If it happens earlier, then obviously that'll be positive because it shows better economic growth, but you know, that'll mean rising yields and bond prices will be affected, and no doubt those yielding equities will also be affected.
Jonathan, I'm just wondering what your takeout is from yesterday when we got those private sector credit numbers and we drilled down into them and looked at business credit. Yes, it's rising, but at a lackluster pace. Now, the takeout from that was it's consistent with subdued business conditions. If you accept that, presumably you're going to be fairly bearish on a takeoff for the corporate bond market here, because it would imply if business conditions are subdued, there's little in the way of demand to fuel corporate bond action here.
Yeah, that's one way you could look at it. I mean, the credit, I don't know exactly the makeup of that number, but it comes mainly from the banks, and they're obviously the engines of lending mainly in this country. But in terms of the corporate market, what we've seen in the last quarter is almost a doubling compared to historical rates of the lower rated investment grade paper and high yield paper from corporates in Australia. So it's more a case of, I think, perhaps shifting down that credit curve, and those businesses that are not sort of AAA, AA rated, but looking to expand their operations where they're niche players, but at the top of their niche, and they have a need for capital, and they're seeing the corporate bond market as a way to lock in that funding for an extended period. So whilst those private sector credit numbers were, as you say, a bit lackluster, I don't think that necessarily spells a bad patch for the corporate credit market.
So in terms of that new financial year, how would you paint that picture, I guess, in terms of issuance that's upcoming?
Yeah, look, I think we've still got a lot of issuance. In the first half of this calendar year, we saw a lot of issuance from the so-called kangaroo issuers, being those foreign companies issuing in Australian dollars. That was almost 40% of the issuance in the first half, and I think that will continue. I think, you know, we're an attractive place to get capital from. There's a lot of investors searching for yield, and they'll be willing to invest. I think also that the continuation of those weaker credits, if you like, I mean still investment grade in that area, will also increase, and particularly the high yield market. I think that's what we'll see, much more issuance coming. There's a lot of bonds that are being redeemed or maturing in the next half, and that will mean there's a lot of cash to put to work.
Brief final thoughts. As we know, Westfield Retail Trust, WRT, the rating was cut by S&P to A from A+. Of course, as it transitions into that centre group, have you got any views now on direct implications?
Look, I don't have any particular views on that particular credit. I think A flat is still a very strong rating. One notch down from A+ to A is not necessarily a large downgrade. I think that's, you know, still a very strong credit, and you'd be comfortable holding debt in that issuer. Yeah,
sanguine and business as usual, pretty much.
Absolutely,
as you would say. Thank you, Jonathan.
Great, thanks, guys.
Jonathan Sheridan from FIIG